Financial inclusion in terms of banking sector and NBFCs has brought positive changes for the corporates in India. So in terms of access to capital, then the co-lending model, so how banking sector and NBFC sector is going to support the corporate sectors in India? So any views going forward?
I can take that question, from an alternative space, and we've done about 26, 27 transactions now.
Yeah.
And when there is this is my core belief, we look at 2 or 3 companies a week. We've done close to about 300 evaluations over the last 3 years. And we look at companies from 100 to 1,000 crore turnover, roughly give or take 20 crore EBITDA and roughly about like 100 crore EBITDA. And we look at non-real estate, non-distress, and non-venture debt, non-early stage. So, we are representing, whatever I'm going to say represents the core manufacturing economy of India. And the way this is happening right now is the banking system, about 60-odd% is still fairly bureaucratic, for lack of a better word.
Yeah.
Private sector banks are there, they're able to do a few things right. But whenever there is a need for an urgent capital, a short-term capital, somebody like a bespoke solution being provided by private credit funds, alternative financing, sometimes NBFCs, if you can structure that solution in a quick fashion, because I think the biggest need today for a borrower is, can you be certain, can you be quick, and can you be flexible? Those 3 words define the space of alternative financing in India today. Those are very simple words, but very big words to implement, given the landscape of governance that we've already spoken about. Yeah. Because you need to be quick and still assess the governance standard. We believe the ecosystem that is developing today, this will create a lot of entrepreneurs on the manufacturing side, where they can, use this capital, which is bespoke, flexible, quick, and certain, to grow this system. And we see that growth happening. It is almost something like a magical thing happening in the core sectors of India. This is what we believe. So this, while it's not financial inclusion, but the fact that we are helping support the small and middle market companies is really happening today. And that's not us at True North. It's happening across the 15, 20 private credit funds that we kind of represent as an industry.
Very much. Thank you, sir.
Thank you. It's quite useful. Any other question, please?
So my name is Shiva. I'm from Rim Barrier Advisors. So my question is to the private equity players here. So is there too much of chase for the investment in the green business, which is far more riskier than the brick and mortar? If somebody comes with a very solid investment proposal, and then if you compare it with the proposal for a green investment, I think there is always a focus, there is always a prioritization for the green business. Is this true? Probably from the investment banking perspective, we believe that this is so. Maybe your view from Rishi or Nikhil.
I think the green investment is actually a sub-segment of the overall investment opportunity. I think there are a few players that are exclusively focused on green investment, but that's a very small pool. I think the reason that green investments eventually end up getting priced at a lower return in India especially is because a large part of the green investments are around renewable energy development, which fundamentally is an annuity business and backed by cash flows from long-term contracts with government, quasi-government agencies. So they kind of tend to be priced at the mid to maybe high teens IRRs, whereas private equity players end up looking at low 20s to mid 20s IRRs. So the pricing is cheaper. I do think that's just adjusting for the nature of the investment and the risk. So in that sense, I would say while it's a large pool of capital and there is a lot of capital chasing that pool of investments, I'm not sure I would say that there is, I would say generally there is excess capital chasing investment opportunities in India, whether in equity or in debt. I think it's a liquidity flush market. But I'm not sure, at least I share a view that those are particularly mispriced in terms of risk.
I would just add that I don't think there is a preference for green investments. At the margin, I would even say there has been a misuse of the word green, right? Maybe a controversial comment, but I think that is what we would think. As a core thesis, for example, as a fund, I don't think we are saying that ESG standards obviously need to be met. So I'm not counting that as this sort of green representative of investment. But if there is an investment, we will evaluate clearly on its full merit rather than saying that you need to give a certain handicap or an advantage to a green investment.
Yes, sir. There was a question being asked from gentlemen. Yeah.
Hi, my question is from Rishi and Raghav, my friends from private equity side. Being in the field for last 35 years is my sixth cycle of ups and downs. What I've seen that when the companies does well, they need capital to grow. When the companies does bad, then also they need capital to sustain or be ready for the next cycle. So how do you manage a situation, because you are a contractual marriage with the companies of a certain period, 3 years, 5 years, 2 years, 7 years, what will be the period? So the time when your investments is maturing to a time of exit, at the time at the company needs capital, how do you manage the entry and exit of a capital at the same time when you have to exit and the company needs capital? How do you manage that conflict?
Mahesh, I would say I don't think it's such a big conflict in terms of, I would say you need to be aligned to the need of the organization, right? That has been our motto practically from day one, right? Whether we take a 10% stake or we take a 50% stake out there. So I think if the exit period has to be extended, given a market downturn or excessive competition or pricing or anything out there, I think both shareholders, all shareholders on the cap table have to be practically aware and upfront about it. In terms of trying to offer exit avenues, frankly in India, those exit avenues are increased in I would say in the last 5-7 years as this market has got more sophisticated. There is something called a continuation fund. People are talking, saying that you've been through a portfolio company for 5-7 years, and now, right, you may potentially have another ride with that portfolio company through a new fund and new set of investors, which can give you another life for 5 years. So I don't think there's such a big conflict to potentially manage in terms of, and you have to do what's right for the organization and for the issuer company.
So if your mic could be passed on to the gentleman sitting there.
So this is just a general question. We are a $4 trillion economy and we have 1,400 million people. One company, NVIDIA, is a $5 trillion company with just 30,000 employees. Where we can really scale up, where India can scale up and how?
I mean, it's a quite a general question, but let me request.
We are
Rishi,
solving for third world problems. First, I mean, it's a simple answer. Let's solve for manufacturing. Let's solve for building homes. Let's solve for building infrastructure.
Yeah.
Our time, coming to building a $5 trillion AI economy company will also come. I think there's still some time.
Rishi, you were trying to add something.
I mean, I think it's, again, similar stage of economy, right? Where we are in our economic cycle is very different from where the US is and where the whole Silicon Valley economy is. I think the challenge in India, I think, has been more around fundamental innovation. I think this kind of value creation will come from fundamental research, fundamental innovation. While we do have significant amounts of innovation in India, I think it's more incremental in nature and less revolutionary or fundamental in nature. Given the stage we are, I think we have to invest more and more in fundamental innovation, but unfortunately resources are constrained. I think we end up spending much more time investing in earlier stage needs on the Maslow's hierarchy, and I think we'll eventually hopefully get there at some point. I don't know how long or how soon, but that's the hope, I guess, or the promise.
Thank you. So I think we are exhausting our time. How much time is left?
It's a wonderful discussion. If you want to continue.
No, just, yeah.
Hi, my name is Pooja Nirarkar. Thank you so much for this amazing session. It was quite insightful. My question is in line with the, not per se in line, but I think in addition to what we spoke about, we see a lot of patient capital in the West compared to India. And patient capital is something that does drive the economy. Now, there's a conflict here because Indian investors are not really patient. We see a lot of alt credit funds as well as private equity funds being shorter in tenure compared to the West. So how do we solve for that conflict? What do you see for India, and how do we get to the patient capital that's existing in the West?
We need to have more Japanese capital, first of all, patient capital. But let me request our friends here to respond. You want to respond?
I'll take this, I think.
Yeah.
No, I think this notion probably, I don't know what is the background to this, but we have moved from patient capital in private side, which private equities invest from 5 years to about 8-9 years, to now even in public markets. In public markets, earlier the capital in the hands of mutual funds, AIFs, etc., was so low, and as that AUM has started to expand, even the capital, the tenure of that capital which remains invested in even public equities is going up significantly. So in fact, I'll say that whether you take example of private credit, who are also giving structured solutions to companies from 5 years to 7 years, and private equities who are investing up to 10 to 12 years, and in certain companies there have been serious partners, and then Raghav mentioned about the advent of this continuation funds also coming in, and all the way to public equities. The life of large investors in a company is actually growing. So contrary to what some of us may think and may have certain examples for, it's actually changing towards the other side. So definitely longer the better, and that's what will build the economy. And I believe one of the biggest reasons for companies to be able to execute on their projects, whether as private as well as public, has been the increasing longevity of these funds which are coming into the market.
So before we end the session, I had a lot of requests from, sorry. Yeah, please, yeah.
I think we are seeing a trend of long-term holding even from a corporate side when we